High dividend yield is not the same thing as stable cash flow. That sentence matters because many investors see a monthly distribution, a quarterly dividend, or a high yield number and immediately translate it into safety. It can feel like a second salary. It can feel more disciplined than selling shares. It can feel like the investment is paying for life without touching the principal. But household finance has to ask a harder question. Is the cash flow sustainable? Is it coming from a healthy asset? Will it still help at the exact time the household needs money? This episode is educational only. It is not a recommendation to buy, sell, hold, or avoid any stock, fund, or strategy. The goal is to use 3 checks before treating high dividend assets as income planning tools. The first check is the source of the distribution. Dividends do not appear from nowhere. For a single company, a dividend should be compared with earnings, free cash flow, debt, reinvestment needs, and capital allocation. If the company earns money consistently, converts profit into cash, keeps debt under control, and still has room to invest in the business, the payout has more support. If earnings are falling, free cash flow is weak, and management keeps a high dividend only by borrowing, selling assets, or reducing necessary investment, the headline yield may be masking stress. A high payout ratio can be a warning sign when the business cycle turns. For funds and ETFs, the source can be even more complicated. A fund distribution may come from dividends, interest, realized capital gains, option premiums, currency effects, distribution smoothing, or a return of capital. These sources all look like cash arriving in the account, but they do not mean the same thing. If part of the distribution is simply capital being returned to the investor has not created extra purchasing power. The fund has converted part of net asset value into cash. That may still be useful for planning, but it should not be confused with income generated by the portfolio. So the first reaction to a high yield should not be excitement. It should be investigation. Ask where the cash comes from, how often that source has been tested, whether the issuer explains it clearly, and what could cause it to shrink. For a company, review payout ratio, cash flow, balance sheet, cyclicality, and dividend history. For a fund, read the prospectus, distribution policy, historical distribution composition, expense ratio, and portfolio holdings. If the source cannot be explained in plain language, the yield number is not yet a plan. It is only a prompt for research. The second check is total return and price risk. Many investors focus on the cash received and ignore what happens to the market value of the asset. Imagine receiving $6,000 in distributions while the account value falls by $20,000. The cash flow line looks positive, but the household balance sheet is weaker. That does not mean distributions are useless. It means the real investment result is the distribution plus price change minus taxes, fees, and trading costs. A distribution can be psychologically comforting, while total return is disappointing. High dividend strategies can also carry concentration risk. In some markets, high-yield screens may tilt toward banks, utilities, telecoms, energy, real estate, mature industrial companies, or other cyclical sectors. Those sectors may produce cash in certain environments, but they can be sensitive to interest rates, regulation, commodity cycles, credit conditions, or economic slowdowns. An investor may think they bought stable income when they actually bought a concentrated exposure to the same macro environment. Diversification is not only about owning many positions, it is about avoiding dependence on one risk source. There is another price risk issue. A high dividend yield can rise because the dividend increased, but it can also rise because the stock price fell. Sometimes the market is wrong and the yield is attractive. Sometimes the market is warning that the payout may be cut. The yield number alone cannot tell the difference. Investors need to ask why the yield is high. Is the business temporarily unpopular but financially strong? Is the industry declining? Is the company over-distributing cash? Is the fund using a policy that may not match future returns? Without that diagnosis, a high yield can become a value trap. Is it for a down payment in 3 years? Is it for emergency reserves? Or does the investor simply enjoy seeing cash arrive? These needs require different assets. Money needed soon should not depend heavily on volatile equity prices, even if the current distribution looks attractive. Retirement spending may need a mix of cash reserves, bonds, diversified growth assets, and a planned withdrawal rule. A dividend strategy can be part of that mix, but it should not be the only answer. Many dividend decisions are really spending plan decisions. Before choosing an income asset, a household should map essential expenses, flexible expenses, health costs, insurance, debt payments, family support, taxes, and emergency reserves. Then it can decide which expenses need stable cash, which expenses can be flexible, and which assets can carry market risk. If that map does not exist, investors may chase yield because it feels like income, not because it matches a real liability. The order matters. First, define the spending need. Then choose the investment tool. It also helps to separate dividends from withdrawals. Many people feel comfortable spending dividends and uncomfortable selling shares. Dividends feel like harvest. Selling feels like consuming principal. But in total return investing, both actions convert part of the portfolio into spendable cash. The important questions are whether the withdrawal rate is sustainable, whether the asset allocation is diversified, whether the timing rule is clear, and whether the plan survives bad markets. Selling a small amount by rule is not automatically worse than receiving a high distribution. Chasing a risky distribution to avoid selling can create more long-term risk. A practical framework is a three-layer dividend table. The first layer is source. Write whether the distribution comes from operating profit, free cash flow, interest, realized gains, option premiums, or return of capital. The second layer is risk. Write price volatility, sector concentration, interest rate sensitivity, recession risk, currency risk, tax treatment, fees, and liquidity. The third layer is use. Write whether the cash is for living expenses, reinvestment, short-term goals, retirement withdrawals, or psychological comfort. If all three layers are clear, the dividend can be evaluated as a planning tool. If the only answer is that the yield is high, the analysis is incomplete. Inflation adds another layer. A stable nominal distribution is not the same as stable purchasing power. If living costs rise faster than the distribution, the household can still feel pressure. Retirees should pay attention to health care, long-term care, rent, insurance, and family responsibilities because those costs may not move neatly with dividend schedules. A plan that works this year may be weak 10 years from now if it does not include inflation, growth assets, spending flexibility, and a reserve for surprises. Taxes and fees also change the final result. Different accounts and jurisdictions treat dividends, interest, and capital gains differently. Funds have expense ratios. Trading and currency conversion may create additional costs. A strategy that looks attractive on a pre-tax yield basis may be less attractive after costs. Household planning should compare after-tax, after-fee, risk-adjusted cash flow, not only the number displayed in a fund advertisement. The cash that matters is the cash the household can actually keep and use. If you already own high dividend assets, run a stress test. What happens if the distribution is cut by 30%? What happens if the market value falls by 20%? What happens if interest rates rise, a recession arrives, or the fund changes its policy? Would you have to sell at a bad time? Do you have a cash bucket for essential spending? Is the position too large compared with the rest of the portfolio? A stress test does not predict the future. It checks whether the plan is resilient when the future is less comfortable than the brochure. A more balanced approach is to put high dividend assets inside the broader asset allocation, not let the dividend yield design the entire portfolio. The core plan should still reflect goals, time horizon, risk capacity, income needs, taxes, insurance, and diversification. High dividend stocks or funds may serve as one tool for cash flow preference or value exposure. They should not automatically replace global diversification, fixed income, cash reserves, insurance planning, and long-term growth assets. A portfolio can respect the usefulness of distributions while refusing to worship the yield number. Here is the summary. Before treating high dividend yield as stable cash flow, check three things. First, source. Is the distribution supported by earnings, cash flow, realized gains, or is some of it capital being returned? Second, total return and risk. Are you counting price changes, taxes, fees, concentration, and market cycle exposure? Third, household fit. Does the distribution schedule actually match spending needs, emergency reserves, retirement withdrawals, and tax reality? High dividend investing is not automatically bad. It is also not automatically safe. Use the yield as the beginning of due diligence, not the end of decision making. A durable income plan is built from sources, risks, and spending needs together, not from a single attractive percentage. One useful way to make the first check concrete is an evidence ladder. The lowest rung is only a product name or marketing phrase that says high dividend. The next rung is a portfolio that actually owns income-producing assets. Above that is a clear source, such as earnings, interest, rent, realized gains, or auction premiums. The next rung asks whether cash remains after expenses, taxes, capital spending, leverage costs, and currency effects. The highest rung asks whether the source can survive a weaker economy, changing rates, or a market decline. The higher the evidence sits on the ladder, the closer the distribution is to a planning tool. If the evidence stops at the label, it is not yet a cash flow plan. Investors can also use a simple scenario matrix. In the optimistic case, earnings are stable, the fund holdings are diversified, the distribution source is transparent, and prices do not fall much. In the base case, distributions fluctuate, but the household has cash reserves and flexible spending, so it does not need forced selling. In the stress case, the distribution is cut, market value falls, inflation raises expenses, and cash is needed at the same time. The question is not which scenario feels most likely today. The question is whether the current position size still works if the base case or stress case arrives. Position sizing turns the idea into a rule. A household might keep 1 to 3 years of essential spending in cash or short-duration reserves, hold diversified long-term assets for growth, and place high-dividend assets in a limited income or satellite sleeve. The limit is not a statement that dividends are bad. It is an admission that every strategy can disappoint. If the sleeve grows beyond its limit, rebalance. If the distribution source weakens, review it. If the yield rises only because the price fell, ask whether the market is offering an opportunity or warning about a future cut. Review cadence matters too. Do not rebuild the plan after every social media post, and do not ignore it for years because the cash keeps arriving. A practical schedule is to review after earnings, fund distribution reports, annual household budgeting, major spending changes, or portfolio weight breaches. The review should cover source, total return, taxes, fees, concentration, spending match, and fallback plan. This creates discipline without pretending that any yield number is permanent.